All right. Well, folks, hello and welcome back to the Money Wisdom Podcast, powered by Johnson Brunetti. We are glad you're with us. I'm Nick Colantuono. I'm a certified financial planner up here in our Boston, Massachusetts offices. Jake, glad to be back with you, my friend.
As always, my friend, my name is Jake Doser. I'm a certified financial planner, certified private wealth advisor down here in our Connecticut offices. Looking forward to our episode today.
As always, we've got a fun one, don't we? Today's question is, Nick, Jake, the team at Johnson Brunetti, how do interest rates work? So let's unpack that because there's a lot that goes into it, obviously. But, there's a number of questions behind the question, and there's a lot of noise out there right now. You turn on the TV, it's, President Trump fighting with the chairman of the Federal Reserve, Jerome Powell. He wants him to lower interest rates. And why? Why would he want that to happen? So how does the Federal Reserve's decision when it comes to whether to raise or lower interest rates, how does that really affect the overall economy? And like I said, Jake, the question behind the question for our clients, how does that potentially impact our retirement? So there's a little bit that we have to go into about the Federal Reserve itself. First of all, what is the Fed, as it's called? It's the U.S. central bank. It oversees monetary policy for the U.S. government. Founded a long, long time ago, 1913, chaired up right now by Jerome Powell. And there's a committee that sort of runs the Fed. But interest rates have a big impact on a number of things. So, Jake, I want to just throw some of these at you and see if you can unpack it a little bit. So interest rates obviously have an impact on borrowing, right? Talk on that for us.
Yeah. So all of us think about our next topic of saving, but which I'll leave there for there. But we think about interest rates and we're faced with that when we're thinking about our mortgage, right? So our borrowing capacity is set based on the interest rates partially. If you have a mortgage that has a balance of $400,000 and your interest rate's 3%, your payment's going to be, on a house in Connecticut, less than $3,000 a month. Whereas if you have that same mortgage of $400,000 and an interest rate's 6.5%, which is where mortgages are sitting around right now, your mortgage is going to be substantially more than $3,000 for the same principal amount. And so right now, when we're in a comparatively, compared to the past few years, higher interest rate environment than we have been, it costs more to borrow money. And the Federal Reserve's mindset is when it costs consumers in America more to borrow money, they'll spend less money. And in times when inflation goes up, which is the time of our United States history we're in post-COVID, when COVID, everyone gets sick, people aren't going to work. People aren't going to work, supply chains are impacted. Supply chains are impacted means everyone's demand for products are still high, but places can't get their stuff to people. And so they have to raise prices to get workers in the door, to be able to get the products out to the consumer. And they take advantage of that a little bit as well. So products are more expensive to Chick-fil-A. Chick-fil-A raises the price on Chick-fil-A sauce and hamburger sandwiches. And consumers pay more money for the same chicken sandwich. Right. So
they will.
That's right. And so when interest rates go up, the Federal Reserve says inflation is bad. We want to make it more expensive for people to borrow money. And if they are spending less money, businesses should lower prices. That will kick our economy back in gear and lower inflation a little bit. That's the idea. But interest rates impact borrowing because lower rates means it's cheaper to spend money. It's cheaper to use money. It's cheaper for businesses to invest in their businesses. It's cheaper for us to finance our kids going to school, et cetera. Higher rates, it's more expensive to borrow money. Houses might not go as fast, et cetera. So big impact in the lending space.
Yeah. You're right. I often think of the cost of debt, right? So the higher the interest rate when you're taking a loan, the more cost you're going to have to maintain that debt. And I also think of it from the government standpoint. And I'm just trying to think of why is, again, I get it, wanting to lower interest rates, free money supply, stimulate the economy. But there's also this push for President Trump trying to get the Federal Reserve to decrease interest rates because we have a lot of sovereign debt as a country. Right. So if interest rates can be lower, in theory, our government can then refinance a lot of that debt that they have. And think of the cost savings. Again, you mentioned the difference in a monthly mortgage payment. What if we're talking about trillions of dollars in debt, at a 7% interest rate versus a 5.5 or 6% interest rate. I mean, we're
right.
talking about meaningful amounts of savings. So just to shine light on the difference between, consumer debt, but also sovereign debt, which is something that the Federal Reserve, as the central bank of our country, certainly has to be wary of.
That's exactly right. And it's the nation's bank. It's their job to play a game that's difficult, is to make sure that we don't have hyperinflation like what was happening in our country in the 60s and 70s, where generally speaking, it's agreed that the Federal Reserve acted too slowly. They didn't raise interest rates fast enough. And so, prices went up, absorbently high, went through the roof, and it resulted in people with gas lines because prices were so expensive everywhere, and people love those times when CDs were paying 15%, but they hate that mortgages at the time were 20%, right? So there's this relationship that we have to be aware that interest rates really impact our economy. What's next, Nick? What are we talking about next as far as interest rates?
Well, now it all comes down to saving.
Yeah.
So how could interest rates impact one's savings?
Yeah. So, I mean, we've already alluded to that, is that while it's not friendly to have a high mortgage, it is not a bad time for those people who are possibly in retirement right now, where they want to have a little bit more money safe in something risk-free like a CD at the bank or their savings account, right? So conversely, those rates are a lot more attractive. I just got off the phone with somebody this morning who took out a CD in 2023, doesn't mature till 2027, 5.5% interest rate. I mean, that's a killer risk-free rate of return.
Mm-hmm.
Now, certainly not appropriate for all of their money, because a CD cannot be liquidated without losing interest or a penalty to your principal, but certainly a good, safe, risk-free solution for a portion of someone's money. And if I'm leaving money at the bank, I might as well get some good interest rate on it. And so interest rates for the savings world are not quite as high as they were a year or two ago, or CDs might not be as long because banks realize that interest rates are likely to go down soon. But generally speaking, it's a lot better time to be a saver right this second than it was 5 or 10 years ago. And likely it's a better time to be a saver than it will be in 2 or 3 years from now, as far as the rates of return on your money at the bank.
So let's flip that coin, because obviously interest rates impact savers in a very different way than they impact spenders. So when it comes to spending, I often think of interest rates, like higher interest rates will hurt spenders, but help savers.
That's right.
Lower interest rates will help spenders because, again, money is cheaper,
right,
but it will hurt savers. So when you go through these periods of fluctuating interest rates, flexibility is key, but also, being in a position where you're not over leveraged, you don't have more debt than you need, and where you have adequate savings, but your savings are not just sitting there doing nothing. They're actually able to work for you. It's a very delicate balance. So when you have lower interest rates, again, consumers tend to spend more because the money is cheaper, right? Now, when you have higher interest rates, that's where they obviously cut back spending, because why would I go buy a house now when rates are, 7%, when, they're going to lower interest rates and I can buy that house, 2 years from now and maybe be at 5.5%, right? So again, just talking how the Fed can, impact money supply, stimulate the economy, or contract from the economy based on how they target interest rates. It's really a fascinating thing. So you can obviously see how the president is pushing one thing and the Federal Reserve is there saying, well, hold on, right? We need to make sure we're doing this the right way. So yes, good to think about. Now let's talk about the stock market here, Jake. How do interest rates potentially impact movement in the market?
Yeah, so there's never a direct correlation with interest rate movement, but generally speaking, when interest rates go down, that oftentimes gives boosts to stock prices. And think about it, it makes sense. If I'm a company, if I'm Walmart, and I can invest more in my corporation, either growing or buying more stock or, supplies, that is, things like that. Well, if interest rates are lower, it's cheaper for me to borrow money. I can spend more money on my company growing, and that matriculates into the stock market. So stock markets oftentimes at least get a temporary boost when interest rates go down. And conversely, when higher rates are present, it slows the economy down. And in some ways, the Federal Reserve is counting on that, because if the economy slows down, people are buying less, companies are expanding less. It causes this moment where money is a little bit more restricted, and people spend less money, and they might take advantage of that because inflation might be going up. So they want to slow business growth down so inflation slows down. Once inflation's at a slower, more sustainable level, they might slowly drop interest rates, and that's what President Trump is effectively saying he thinks is taking too long right now. Is, hey, our economy is doing well, but it could be doing a lot better if the Federal Reserve would drop interest rates so our economy could take off. Again, this is not a time to endorse nor indict those things, but rather just let's demystify what's going on in the news. Why is this so relevant? So stock market is definitely impacted by interest rates.
Mm-hmm. The money has to go somewhere.
That's right.
Right. And if it's sitting in the bank and you're comfortable and you're able to get 5 or 6% by just not doing anything, that's all good and well. Right. So when interest rates are higher, we see some money flow out of the market, go into those safer asset classes. People have more predictability. But when interest rates are low and now those savers are no longer being compensated for that saving, the money has to go somewhere, right? So that's where we can see it then flow back into the market because people want that money to work at least as hard for them as they've worked for it. So again, it's a balancing act. And folks, if this conversation shows anything, it's that it's very unpredictable, right? We're not sure what the road ahead is going to look like as far as interest rates. I know the general consensus out there is that there's going to be an interest rate decrease. Who knows? We won't know until push comes to shove, and that's actually, the case. But what we do know is for our clients are are more often than not both savers and spenders. They've got cash or assets in the bank. They've worked very hard to put themselves in a position where they can approach the road ahead with clarity and confidence and have a reasonable level of safety. But at the same time, we talk about it all the time on this podcast, Jake. Gone are the days where you retire at 62 and you're lucky if you live to 75. Right. We have to plan for 20, 30 plus years in retirement. And as a result, we also believe in market exposure, and so too do our clients. And what it all comes down to is having a plan. So we want to offer our Money Map book to everyone watching, everyone viewing. This book really shines light on our philosophy as a firm. It's going to talk through some of the strategies we're using with our clients. It's really going to show, if anything, how all these different levers that can be pulled can impact you and your retirement. And that's really what it's all about. So we want everybody watching, everyone viewing to get that book. Do so by texting the word MAP, M-A-P, to 800-757-0436. Again, that'll get you our Money Map book. Text the word MAP, M-A-P, to 800-757-0436, and we'll get that out to you ASAP. It's a critical resource. And again, it's just going to really shine some light, not only on this conversation that Jake and I are having here, but really the overall conversations that you need to be having when it comes to your financial planning and retirement. So now we get into the fun part of the adventure. Obviously, every conversation you and I have, Jake, is a fun one, but we're implementing what is called the Mailbag Minute, where we're taking viewer questions. So folks, listeners, if you're viewing and you want your question to be answered by Jake or myself, send it in to us. And it'll allow us to hopefully get some content out there that our viewers want to hear. So Jake, why don't I throw these out to you and we'll see. I know it might be a little tough for you to answer these in a minute, but we'll see. So first question is really related to, again, today's topic on interest rates. And this viewer writes, I have a lot of credit card debt that is high interest and I can't keep up. How can I try to get out of this debt?
It's a good question. Addressing high interest debt is always one of the first things that somebody should be doing when they're thinking about their plan. An investment that might average 6% is not nearly as good as paying off a credit card that's charging you 20%. In a sense, you almost get a guaranteed rate of return, if you will, when you pay off a credit card. And so it's important when you're thinking about your income planning to evolve it beyond just where am I going to get my income, but what cash flow do I need to manage? So with that being said, you've got a high credit card debt. Generally speaking, we kind of implement two types of approaches when you're paying off debt, either the avalanche method or the snowball method. The snowball method is what you do is you look at each of the debt things that you have, you pick out the one with the smallest payment, and you aggressively pay that off with all the extra cash that you have. And then once you pay that off, let's say it's $50 a month, and you actually are able to pay $100 a month to it, you don't stop with that $100 a month payment. You take that $100 you were throwing at credit card number 1 and you throw it at credit card number 2 along with its minimum payment. Next thing you know, these large payments snowball into a massive debt. It psychologically feels really good and allows you to accomplish it. It doesn't save you quite as much money, but it does tackle debt in an effective way psychologically. The second one is an avalanche method, and it's almost the opposite. You start with the loan item or the credit card with the highest interest rate, and you tackle that first because it allows you to save money fastest, and then you work your way down. Whatever method you employ, make sure you address high interest debt and make sure that you're not cutting off your nose to spite your face. AKA, I'm saving over here really well, but I'm paying out the nose in credit card debt. Make sure there's a balance.
I like those strategies. I'm a big believer of small wins.
Yeah.
Having said that, the numbers, the math doesn't lie.
The maths.
Yeah, the snowball method, I get it. You kind of pay off those smaller balances, start with the wins. That feels good. The avalanche method, you're definitely going to save a little more money in the long run, tackling the higher interest rate first. So that's really helpful. Thanks for sharing that.
Yeah.
Next question. I am currently working. I only have a mortgage payment, no other debt. Awesome. Should I withdraw from my 401k to pay off that mortgage when I retire?
Yeah, and it depends, just like in many situations. I think about, is it good debt or bad debt? If you ask Dave Ramsey, all debt is bad debt. But I don't think that's the world that we live in 2025, where, it costs 6 to 8 times your annual salary just to buy a house, compared to 20 years ago, it might have cost you 3 times your salary. So debt is something that we shouldn't avoid entirely, but rather manage our relationship with. So with that being said, I think of debt in 3 categories. Good debt that's 4% or less. That's debt where I could take that money and use it elsewhere and actually maybe make more money than I'm paying. Okay debt, I guess I would categorize anything from 4 to 5% in that range, where it's not great, it's not awful, it lives in the middle. And then bad debt would be really anything 5% or higher. That's debt where, hey, my investments are likely not keeping up with the rate at which I'm spending it. So, simply put, we just plug that mortgage listener into that situation. Is it bad debt? Well, maybe prioritize that over your saving. Is it good debt? Well, maybe it's important just to leave your money invested. And then the final thing is recognize that your plan is only as good as its flexibility. In retirement, if you've got a bunch of money and you're going to have leftover, and maybe it will cost you a little bit in investment opportunity, but you just like to have the mortgage paid off, there's nothing wrong with that either. There's got to be a balance between the math and what makes sense. We make plenty of decisions that aren't always math oriented. And in retirement, having a plan allows you to make those decisions in an informed way. So if you've got $5 million, you only spend $100,000 a year, and that debt's keeping you up at night, you should probably pay it off, even though it might not save you extra money. What else is your money for? It's for you to be able to use and not worry.
Little things mean a lot. Peace of mind goes a long way. That's for sure. And let's close it out with one more general retirement question. Jake, what's the best account to grow your money?
What's the best account to grow your money? Man, what a loaded question. Here's where we tell you the magic bullet that we've been keeping for 30 years. Now, there's no magic bullet. There's no one size fits all approach. But when we're thinking about the word grow, generally speaking, there's no guarantee for it, but the stock market's always grown. So if you're looking for long-term growth, you should be investing in the market. Your growth expectations, however, should be balanced by your need for growth. When you're 30, you can grow because you're not touching your money for 35 years in your 401k. But when you're 70 and you've done a majority of the growing in your life, at this point, you still need to grow, but you don't need to be as aggressive about it. So inform your growth expectations based on how much growth you need to make your plan work, not based on what's exciting, because it's a lot more dangerous when you've got the most money you've ever had in your life to take lots of extra risk and try to get growth than it is to lose too much. So balance that expectation. But short answer, the market.
Well said, my friend. Thank you for the sage advice. So folks, we've unpacked a lot today. We've talked about a lot today. We want everyone to get that Money Map book that we are offering. Again, text the word MAP to our team. Text it to us at 800-757-0436. It's going to get you this Money Map book. Like I said, this shines light on our financial planning philosophy, talks about some of the strategies we're using as a firm, and it'll help you really game plan the road ahead from an income standpoint, a tax standpoint, an inflation standpoint. A lot gets thrown at you in this next phase of life. And if you're listening or viewing our podcast, you know just how the little things can mean a lot going forward. So as always, we appreciate the viewership. We appreciate the listenership. If you found this video helpful, feel free not only to like or subscribe to our channel so you don't miss any of our awesome content in the future, but what's even better, share it with someone who you think it could help. So folks, for myself, Nick Colantuono, Certified Financial Planner here at Johnson Brunetti, and my co-host Jake Doser, Certified Financial Planner down in our Connecticut offices, we appreciate you watching and tuning in as always, and we'll see you next time.
Johnson Brunetti is a marketing name for the businesses of JB Capital and JN Financial. Investment advisory services offered through JB Capital LLC. Insurance products offered through JN Financial LLC.